following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Let's talk futures. Joining me live, Chief Economist of the CME Group, Erik Norland. Erik, good morning.
Good morning. Thank you for having me.
Appreciate you being here. Now, are you in Chicago or are you in the UK now?
I'm actually in Chicago. Yeah, I got to Chicago. I was actually in Chicago last week. I went to DC for the weekend and then came back this morning.
Nice. Now, is this part of a 4th of July vacation coming up, maybe?
No, I had a bunch of client events in New York and Chicago last week, and then today we welcomed our new economist, who hopefully, Mark Shore, will hopefully be on your program before too long.
I just had the pleasure of meeting him. Yeah, just let me know. We'll get you in here. Love to talk to him.
Great.
Oh man, so where do we start? We have a lot of stuff to talk about. I'm thinking in terms of what's going on with the different central banks, especially the Eurozone versus the U.S. And is there a differential that's being created there or not? What's the status there?
Yeah, so I mean, the ECB has already cut rates, where the Fed obviously hasn't. So the differential's already begun. Part of the deal is that Eurozone core inflation is coming down more quickly than core inflation here in the US. They have it sub 3% there, where ours is still a little bit above 3%. And when it comes to economic growth, the US economy continues to grow. We had positive growth in the first quarter. The first quarter, the economy was growing at a 1.3% annual rate from the fourth quarter, but that was actually 3% compared to the first quarter of the year before. Looks like Q2 so far, if you look at the Atlanta Fed's nowcast, it's maybe going to come in around 2%. It's a little hard to say. We have a whole month's worth of data for June that we don't know much about. But Europe, they have almost no economic growth. Some of the countries are in recession. Some of the countries are barely growing. So the economy is just in a really different state.
Yeah, like Germany's PMI came out this morning. That wasn't that great. I can't remember the exact. It was in the 40s. It was a 40 handle, and a lot of PMIs came out that weren't that great this morning.
Yeah, I think there's a lot of softness in the European economy, and there has been for a long time. The Europeans spent a lot of money on COVID, but they didn't spend as much as the U.S. did. And they didn't really have anything equivalent to the Inflation Reduction Act. So they didn't get as much of a fiscal boost as the United States has gotten. And so, as a result of that, their inflation rate's a bit lower, and their economic growth rate, because the government spending isn't growing as quickly, is also a lot lower, which puts the ECB in sort of a pole position for cutting rates, whereas the Fed is still kind of on the fence, it seems.
I see. Now, is the ECB historically behaved like the FOMC, where once they start cutting, it's a cycle, they'll keep going?
Yeah, I think often that's been the case. Yeah, they seem to like to do at least two moves. I would be surprised if we didn't have a second move at some point later this year. Yeah, I think that there are significant chances it could be a cycle. I do think it depends on their core rate of inflation and on the currency. So long as the euro currency remains above parity, they'll probably be okay. If the euro currency drops below parity, it may be sort of a psychological barrier for them to keep cutting rates if the euro gets too weak. But for the moment, the euro's been kind of holding its own around 107, 108, not really moving very far.
So that begs the question. I don't know the answer to this. When's the last time we weren't at parity with the euro?
Well, the euro dipped below parity, I guess, for a while, a year or two ago. I don't remember exactly what the dates were, but it has been below parity in sort of recent times. Yeah.
Okay, so that's below 1.000.
Yeah, exactly. And it's not It's not an economically significant level, but it is a sort of psychological level.
Yeah.
Like the ECB got quite upset at the very beginning of the currency back in 1999 and 2000 when the currency plunged from its initial level of about 115 versus a dollar down to as low as 0.83. And at that time, the ECB was pretty hawkish and did some unexpected rate hikes in order to
Mhm.
defend the currency. Um, but yeah, I think that the main issue for them is they want to keep that core inflation rate coming down.
So do you will the Paris Olympics be kind of an outlier? Will it generate so much economic everyone's talking about the economic advantages you get for having the Olympics. Is that just a little bit of a blip or is that a real thing?
It's going to be a blip for France, and it's going to be a drop in the ocean for Europe.
Okay.
I mean, Europe's a really big place. I mean, for France, you might see a bump in the economic data for the third quarter. I spent 10 years living in Paris. All my friends tell me that the prices have been jacked up for everything you can imagine. The hotels are all really full.
Yeah.
Airbnbs are full. There'll be a lot of consumer spending. But aside from that, though, it's not going to have a big impact on the euro area as a whole.
Yeah, I was thinking of going, but I saw the prices of the accommodations and like, well, I could stay for free in Zurich, but I have to take a train, and that didn't seem like it would work out.
Now, it's a long train. It's 5 hours train from Zurich.
Wow. Okay. Now, good thing I didn't do that.
Yeah.
So, well, let's pivot over to what's going on with Japan. I mean, their currency, it's crazy. This downward trend in the yen US cross.
Yeah. So the Bank of Japan intervened almost about 2 months ago in early May. They intervened, which kind of boosted the currency temporarily. These kinds of interventions almost never work long term because they sterilize them. So basically, what they do is they create is they'll basically buy the currency in the domestic market, but then they'll do the opposite in the bond market. So in the end, nothing changes. So the yen's on kind of a long-term downward trajectory. Their interest rates are now above zero, which is maybe better than negative 10 basis points, but they're just barely above zero. They're in a range from 0 to 10 basis points. So you might call it 5 basis points interest. You can get, 5.375% here in the United States. So the carry differential is still really big, and I think there's a big temptation to essentially borrow in yen by selling yen and then funding in other currencies, which, by the way, can be a really dangerous strategy if you wind up in a risk-off environment like happened in 1998. But for the moment, I think that there's a real temptation to do it.
So meaning you could get caught in a position you think is stable, but it reverses on you really quickly, it's a losing trade.
Yeah, exactly. So what happened in 1998 is the yen had been on a very strong weakening trend, and there was also a very big interest rate differential. They had near zero rates then too, and the U.S. rates at the time were about where they are now. They were a little bit above 5%. But in the summer of 1998, we had Russia defaulted on its debt, which blew up long-term capital management, which caused a huge liquidation of trades. And then in early October 1998, there was a liquidation of the carry trade where the Japanese yen rose by nearly 20% over the period of 48 hours.
Mm.
I don't think something like that is probably terribly likely this time, not a move on that scale in any case. But these currency carry trades are not without risk. I mean, I think partly they work because we're still in a risk on environment. And you see that through very narrow credit spreads, through a rising equity market, very low volatility measures on the equity markets. If that changes, the yen could wind up getting some support.
I see. So what's the Bank of Japan's next move? I'm going to ask you two questions. What do you think that they might do, and what should they do?
Well, I'll tell you what the markets think they're going to do. If you look at the Japanese Tona future, which is sort of like their SOFR, um, that is basically saying that the Bank of Japan is going to very slowly hike interest rates in increments of about 10 basis points over the next several years, and maybe by the end of 2026, get up to the lofty level of interest rates around 0.6 or 0.7%. I think that they're probably right to be very cautious about raising rates. Japan spent a long time in deflation Deflation is very corrosive to the banking system. They finally, as a result of the pandemic relief and et cetera, managed to get their inflation rate up to around +3 or +4%. It was +4 on the headline, about +3.5 on the core. The core rate of inflation is actually coming back down. It's back down to 2.1%, which is right near their target. So since inflation is near their target, it's maybe not a good thing for them to tighten interest rate policy too quickly. And they probably just want to, let the economy do as well as it can. And the economy there's not particularly great. GDP growth has been very close to zero. So I think that they're right to take a very, very cautious approach to further tightening.
Okay, so it's a balance. It really, the recession thing is top of mind for them.
Yeah, and a recession thing is tough for them because if their economy grows at zero, then per capita GDP is still rising because they have a rapidly shrinking population. If you look at the Japanese population, population by age category, it's almost like an inverted pyramid up until about the age of 60 to 70. You have large numbers of retirees, very few new people coming into the labor force. So the fact, even zero economic growth still leaves them better off on a per capita basis. But the other challenge for Japan and a challenge for the currency is the level of the debt burden. So the government debt is over 200% of GDP. When you add in the private sector, it comes to 400% of GDP. These are debt ratios that are nearly twice what we see in other countries, which is the other reason why they can't raise rates rapidly. If you have that much debt and you don't really have a large generation of people coming into the labor force to help finance that debt, it's going to be really hard to raise rates.
Okay, so they would be basically increasing their debt service by raising the rates, less people to help pay for that. Why is there less people? Is it kind of like here, like the baby boomers now are going to retire?
Yeah, partly, but it's yeah. So the U.S. age pyramid, if you want to call it that, is basically the U.S. has almost like a solid block. We have roughly the same number of people who are 0 to 10 as we have 20 to 30, as we have 50 to 60. In Japan, it's like an inverted pyramid. They have just a really, really low birth rate and a lot of people who are now retirement age. And it's a much more dramatic situation demographically than the United States. And then in addition to that, Japan doesn't really have many immigrants. It's not a society of immigrants. And so they don't really have a lot of people coming in to help support this kind of social system.
Yeah, and historically, immigrants have had a lot of children to help the family make that transition.
Yeah, that's right. They often have higher birth rates than native populations in developed countries.
Yeah. Okay. Well, interesting. We'll see how it goes. I mean, when I look at it, when I look at a weekly chart or a daily chart, the old adage, "The trend is your friend," has never been truer.
Yes, that's right. Yeah, I mean, the trend is your friend until one day it's not. But that's why maybe if you were going to trade the yen, you might want to think about a stop loss, for example.
Right. Exactly. 100%. You always got to think about a stop loss, but that's another conversation. So
Yeah.
let's pivot then. Let's go closer to home to our neighbor in Canada. Their currencies again, Canada, US cross has been trending down for quite a bit of time, at least this calendar year. Now a little bit of consolidation maybe, but it's not looking like it's going to rally anytime soon.
Yeah, that's right. So the Canadian dollar trades very closely with commodities. So oil prices have been kind of, in a range for quite a long time. Oil's a big import, a big export for Canada. They also export a lot of industrial metals. With the exception of copper, most industrial metal prices have been quite weak. Aluminum, iron ore, steel have all been quite weak. Lithium and cobalt have been very weak. And then they also export a lot of agricultural goods, and the prices of wheat, corn in particular, have fallen very, very sharply in recent months. Soybean prices, which is not as big in Canada, because Canada is not as warm as the US, so it doesn't grow soybeans quite as easily. But soy prices have also been coming down, along with canola and other things that they grow. So it's been kind of a rough time for their commodity exports, and that's been putting downward pressure on their currency. And also, the Bank of Canada has cut interest rates as well.
Right. And I'm going to ask you the same question there that I did at Japan. Is it expected that that cycle is going to continue, or do they have more of a tendency to pause maybe, or, tweak it a little bit.
Well, there probably will be some pauses. I don't know if they're going to be like in a cycle where they cut at every single meeting, but they
Yeah.
might. I mean, certainly, if you look at their interest rate markets, um, their interest rate markets, they have their own equivalents of SOFR, for example. The curves in basically every country outside of Japan are pointing downwards. So in Canada, Australia, Europe, the US, there are expectations in all of these places of rate cuts. So Canada's no exception.
Okay. Let's again, we got to get as many of these central banks as we can. Let's go back across the pond. Let's talk about the UK. There's been a lot of conversation recently about Brexit being a mistake.
Well, yeah, if you look at the polling of the British public, something like 57% want to rejoin Europe, 20% or maybe 17% think that Brexit was a good idea, and then the rest of the population doesn't really know what to think, which basically makes me think that they were people who voted for Brexit, but then maybe subsequently regretted it. But anyway, the UK is definitely not going to rejoin the EU. The Labour Party, which seems to be well out ahead in the polls anyway, going into the July 4th election, has said that they're not going to entertain rejoining Europe, nor will they attempt to rejoin the common market. But they will, however, search for some sort of rapprochement with Europe, where they might move closer to Europe and maybe get some more favorable trade status, which might be positive for the pound. Yeah. But
Okay,
all
so
this is
there's some.
kind of up in the air until we know what the election results are like on Thursday.
Okay, and then the election. So the 4th of July is the election. Then
Yes.
you get the results. Is this a yearly election? What's the nature of the election? I'm
So
uninformed
the
here.
parliament can serve for terms of up to 5 years. Now, the
Okay.
parliament has some flexibility. It can call early elections. So in this case, they've been serving for about 4.5 years. The last election was in December 2019. But the next election would not necessarily have to happen until the middle of 2029. So it could be up to 5-year term for the next parliament.
Got it. Okay. Yeah, I think the Wall Street Journal had an article recently about if the UK never left, there was no Brexit, then they would have been about 5% better off on economic growth.
Yeah, there's been a lot of economists who've published estimates of that nature. I mean, that's a little bit outside of my expertise to make that kind of analysis, but that is sort of in the ballpark of what I've seen from a number of different institutes that Brexit has created a great deal of trade friction. What I can tell you is before Brexit, if you were a UK exporter and you wanted to sell into the common market in Europe, you had to go through 7 administrative steps. I mean, really basic stuff like paying the other country's value-added tax, invoicing, etc. Now, on average, you have to do something like 30 to 40 administrative steps. So it's created a great deal of trade friction, which has tended to raise prices and reduce trade, and therefore reduce economic well-being and economic growth.
Wow. Okay. Well, that brings us back to FOMC. It seems like, at least looking at the Fed funds tool, things haven't moved much. There's still this chance we'll have 2 rate hikes by December. Cuts, I'm sorry.
2 rate cuts, yeah. Yeah, I mean, I think, yeah, that's kind of what the market is pricing. It's been kind of fluctuating between 1 and 2 rate cuts by the end of the year, which is a lot less than it thought a few months ago. Yeah, some of this is a function of the fact that right now we're in a risk-on environment. So the stock market continues to do fairly well. Credit spreads are very narrow. The economic data is sort of mixed, I would say. It's not entirely positive, but it's positive enough to give credibility to the idea they'll be slow in cutting rates. If any of those things change, they could wind up doing maybe more rate cuts than that. But it's going to be tough because they have the election coming, and I think they'd really prefer not to move policy between now and the election, and probably especially not at the September meeting, unless there's some really compelling reason to do so that they just can't avoid.
So is the November meeting before or after the election? I can't
It's
remember.
after. It's on November 7th. The election's on Tuesday the 5th, and the November meeting will be on Thursday the 7th. Yeah,
Got
so
it.
it's
Okay,
just
okay.
after the election.
Okay, that makes sense. That makes sense. All right. Well, I have my eyes on that CME Group Fed Funds watch tool, which is awesome, by the way. And we'll see how it goes. But again, it seems relatively stagnant as the data is coming in. And, the data seems to be, we had PCE last week that seemed to be okay.
Yeah, I mean, the inflation numbers are coming down. Core PC in particular has been fairly soft, in part because in the PCE numbers, housing doesn't weigh as much as it does in the CPI. Housing is, I think, about 19% of core PCE, whereas rental costs, various measures, is around 32% or so, or 33% of CPI. So most of the inflation we're still having is coming from rising rents and rising insurance rates. Those are a little bit discounted in the core PCE, which is the Fed's favorite measure of inflation. What I think is going to be more interesting to me as an economist will be this Friday's employment report. The employment reports we've seen recently have been very divergent. If you look from the end of November to the end of May, in that 6 months period of time, the non-farm payrolls number, which comes from the establishment survey, mainly of big businesses, has shown we've added 1 million jobs, which is great. If you look at the unemployment number, which comes from the household survey, however, it's shown that unemployment's risen from 3.5% to 4%. And if you look at that particular jobs measure, we've lost 1 million jobs since the end of November. So this is a 2 million job divergence, up 1 million versus down 1 million. And I think that the divergence may come in part because the household survey may be doing a better job of what's happening at small and mid-sized enterprises that are overlooked by the establishment survey that gives us the NFP number. So this employment report on Friday is going to be very interesting, and I think the market's going to react probably initially to NFP, but then it's going to take a deeper look inside. And when it takes a deeper look inside the report, it's going to look at other things like average hourly earnings, the number of hours worked, unemployment, labor force participation, and also the separate jobs creation number that's associated with the household survey.
So, is the household survey really phone calls to people?
Well, I don't know if it's all phone calls, but they try to survey 60,000 people each month. And I think it's tough because the response rates, for phone calls are way down. It used to be like back in the 90s, when we were calling people's landlines, you might get a 75% response rate. Now it's maybe down to 5% or something
Yeah.
like that. But you'd really have to ask them the details. I don't know off the top of my head all the details of how they're conducting that survey.
Yeah. I mean, if I get a phone call on my phone, it says Bureau of anything, I'm not answering that call.
Yeah. And people don't answer their cell phones in general. They just only respond to text messages.
Yeah. Okay. Interesting. So part two of this is there seems to be a lot of folks suggesting all this data is telling us is the more people are getting a couple of different part-time jobs just to make ends meet.
It could be that, but I also think that there are a lot of small businesses that are really making tough choices about staffing. A lot of
Uh,
them are seeing big increases in their cost of bank financing that the big corporations are sort of protected against, as a lot of them issued bonds at very low yields during the pandemic when bond yields were much lower than they are today. And also, a lot of big companies are very cash rich. So they're earning 5% on their T-bill holdings. And look, you see this in the equity market. You have the NASDAQ and the S&P, which are sort of hitting record highs on a near daily basis. And then you have the Russell 2000, which is still 15% below its record high from 2021, and is about 25% underperforming the S&P and the NASDAQ over the last couple of years. So the stock market is also lending credence to this idea that small and mid-sized enterprises are suffering.
well, and the smaller enterprises have more borrowing requirements, right?
Yeah, they have more borrowing requirements and they tend to borrow from banks. And the Federal Reserve of St. Louis has a data series that tells us what the average
Uh,
length of a bank loan is, and it's about 750 days, which is a little bit less than 2 years. So a lot of these loans to small businesses are getting remarked at much, much higher rates.
Yeah, that makes sense. Yeah, me and Tom track that every morning. We look at the major stock indexes, and the Russell is the least bullish of the group, of course, every single day.
Yeah, and if we get rate cuts, especially more aggressive rate cuts than what the forward curve is currently pricing, the Russell could be the big outperformer. So, I mean, it's been underperforming now, but that won't go on forever.
But a dovish environment, if all of a sudden we go cut, 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 that should be good for the Russell, right?
Yeah, exactly. That's what I tried to say. Yeah, the Russell would
Oh,
be the
okay.
big outperformer, could be the big outperformer in an easier policy environment.
Yeah, that totally makes sense. This totally makes sense. There's also a lot of folks calling for a giant sell-off, right? All the stock industries are going to sell off big time going into, September. I don't see that. That's not my value proposition, but there's a lot of doom and gloomers out there.
Yeah, it's hard to say. I mean, the one thing that does interest me is the divergence. There's a lot of divergence going on between equity sectors. This market really is a very narrow rally, as I'm sure you've discussed many times on your program. It's really just a handful of stocks that are taking it higher. And the internal correlation of the various sectors is broken down. Also, the market's overall level of volatility has been quite low, but the volatility of individual stocks has been exceptionally high. Part of that low correlation within the market is what's causing the overall level of index volatility to be low. I don't know quite what to make of that, but it may be a sign that there is trouble on the horizon.
Yeah, well, we'll find out sooner sooner than later. I'm gonna just kind of this now we're not scripted, so I'm gonna throw out another thing for you. So let's talk about AI's impact on some of these individual components and sectors, and what kind of, from a longer term point of view, is this whole AI revolution really going to affect things as positively as everybody says?
Well, it's hard to say. I mean, the first wave of the internet was hugely positive. We got, productivity growth of 2 to 3% per year for a decade from the mid '90s to the mid 2000s. The second wave of the of the internet, social media coincided with much lower productivity growth rates. I'll leave you to think about why that might have been.
Hmm.
So I guess the promise of AI is maybe it could take us back to higher productivity growth rates, but I think that the jury's still out. This is very young technology.
Yeah, no, I know. And so I think that's also fueling the bubble people, right? There's another one of these bubbles. AI is not going to, isn't what it's going to do for a long period of time. Nvidia is going to lose Nvidia is going to lose their monopoly, and then it's going to kind of, fall back to break even.
Yeah, that could be, or it could be, sometimes when there's new technologies, the companies people think are going to initially think are going to be the winners don't turn out to be the winners in the end.
Yeah. Anyway, we'll see. It's been quite a ride for Nvidia, for sure, and we'll keep tracking that one going forward. All right. So really, I mean, it's wait and see for the Fed, wait and see for employment data. It seems to be core inflation is coming back down, and housing is sticky. Is there a point in the economic cycle of things where housing isn't it kind of cycles back down? Is it always I buy a house, 20 years from now it's going to be, I'll be better off or not?
Well, I think housing is in a weird state today. So um, the number of mortgage approvals is at the lowest it's been in 30 years. Mortgage rates, of course, are still pretty high, up around nearly 8% on average. Um, the what's holding the housing prices up is extremely low vacancy rates for both owner occupied and rental housing. That's what's really preventing housing prices from coming down, um, like it did, say, back in 2006, 2007, and 2008, when we had much higher vacancy rates. So the housing market's in sort of a weird state of flux, where the number of housing starts and building permits has also dropped off. So housing construction's not great, but on the other hand, that also means less supply, which also means it makes it harder for prices to come down. So it's just in a very strange state. But basically, the price to buy a home isn't really moving very much, and the price of rents continues to rise.
Yeah. All right, we'll keep monitoring that component of things as it seems to be super important. Erik, I appreciate you being here with us. Erik, Chief Economist at CME. You do a lot of stuff on the website itself and on social media. What's the best way for people to see that? Just go to cmegroup.com and Google you and type your name in?
Yeah, CMEGroup.com, and our research is all on the page, and you can also search it through the search function on the page as well.
Yeah, it's awesome. Well, again, I appreciate your time today. Looking forward to talking to you again soon. Thanks for being with us.
Thank you.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.